Welcome. Today we're breaking down a simple, proven, and highly effective retirement strategy tailored for millennials. Set and forget investing with low-cost index funds. To set the stage, we'll explain why starting early is the single greatest advantage you have, how to pick the right accounts and platforms, which funds to choose, and exactly how to automate the process. Then, to reinforce learning, we'll include quizzes and diagrams that map each decision. Let's begin by previewing what's ahead, and then move step by step from accounts to funds to action. Here's our roadmap. First, we'll cover why starting early matters. Next, we'll prioritize accounts, focusing on why a Roth IRA often comes first for young investors. Then, we'll pick trusted platforms. After that, we'll compare simple index fund choices and discuss why fees matter so much. Finally, we'll build an automation plan and test your knowledge with quick quizzes. Let's add a brief disclaimer before we dive in. Before we go further, this content is educational and not personalized financial, tax, or legal advice. Everyone's situation is different, so please consult a qualified professional to tailor these ideas to your specific needs. With that in mind, let's jump into Step 1 and choose the right platform and account. Step 1 focuses on choosing a trustworthy platform and the right account type. For long-term, passive investing, established custodians like Fidelity, Vanguard, and Schwab provide robust tools and very low expense ratios. Once you pick your custodian, the key decision is account priority. For many young investors, the Roth IRA often comes first due to its unique tax benefits. You contribute after-tax dollars, and qualified withdrawals in retirement are tax-free. This can be extremely powerful over a 20 to 30-year horizon. Let's unpack the details and show a visual decision flow. Here's how to translate the framework into action. First, open your account at a trusted custodian such as Fidelity, Vanguard, or Schwab. Next, focus on tax advantage space. If you have room, prioritize a Roth IRA, because young investors in lower tax brackets often benefit from tax-free growth over decades. If your employer offers a 401k match, contribute enough to capture the full match, since that is essentially free money. After that, continue to max your Roth IRA if possible. Only once you have fully utilized your tax-advantaged accounts should you move to a General Taxable brokerage account. The flowchart on screen guides you through this decision step by step. Now that your account setup is clear, let's compare Roth versus traditional to understand the differences in more detail. Let's compare Roth and traditional IRAs. With a Roth IRA, you contribute after-tax dollars, which means you forego a deduction today, but your growth and qualified withdrawals in retirement are tax-free. This is often attractive for younger investors who anticipate higher earnings and potentially higher tax brackets later. With a traditional IRA, your contributions may be tax-deductible now, reducing current taxable income, but withdrawals in retirement are taxed as ordinary income. Each has rules and potential penalties for early withdrawal. This is a general overview and not personalized advice. Consider your current and expected future tax brackets and consult a professional if you're unsure. With account types clarified, let's move on to the fun part, choosing the actual funds. Now that accounts are set, it's time to choose investments. The goal is to capture broad market returns with minimal cost and effort. That means low-cost index funds. You can choose a U.S.-focused approach paired with international exposure, or pick a single global fund that does it all. Let's explore those choices and visualize a common allocation. For broad U.S. exposure, many investors pick VTI for the total U.S. market, or VO/FXAIX for S&P 500 coverage. To add international diversification, pair with VXUS, or a Fidelity Zero International fund like FZILX. A common, aggressive split is 80% U.S. and 20% international, which you can visualize in the pie chart. If you prefer ultimate simplicity, consider VT, a single global fund that automatically includes U.S. and international stocks. Regardless of the route, stay laser-focused on fees. Expense ratios near zero help you keep more of your returns. Next, to drive this point home, let's quantify how fees compound over time. This table illustrates how small fee differences add up over decades. Assuming $6,000 invested per year for 30 years at a gross 7% return, a low-fee fund with a 0.03% expense ratio nets roughly 6.97%. leading to an ending balance around $563,700. Meanwhile, a higher fee fund at 0.5% nets about 6.5%, ending near $518,800. That's roughly $45,000 lost to fees alone. The exact numbers vary with contributions and returns, but the direction is consistent. Lower fees preserve more of your wealth. With fees in perspective, let's check your understanding with a quick quiz. Quiz time. The question is, which account should most young investors prioritize maxing out before opening a taxable brokerage account? The options are Roth IRA, traditional IRA, general brokerage account, or crypto wallet. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the Roth IRA. For many young investors, tax-free growth over decades is a significant advantage, often outweighing short-term deductions from a traditional IRA. Now that we've solidified account priority and fund selection, let's turn your plan into action with automation. Here is your step-by-step action plan. First, open a Roth IRA at a trusted custodian. Second, select your core index fund or funds, such as a two-fund approach with U.S. and international exposure, or a single global fund like VT. Third, set automatic contributions aligned with your pay schedule. Fourth, invest on schedule and ignore daily noise and headlines. Fifth, rebalance roughly once a year or when your allocation drifts 5 to 10% from target. Sixth, increase your contribution rate every time you get a raise. Seventh, maintain an emergency fund of 3 to 6 months of expenses to avoid selling investments during downturns. Finally, avoid high-fee products and hot stock chasing, because time in the market beats timing the market. To visualize the long game, let's view a timeline of compounding. This timeline highlights the long-term nature of compounding. In the early 20s, the investor opens a Roth IRA and starts with a modest automatic contribution, perhaps $250 to $500 per month, invested in VT or a two-fund mix. Around age 30, contributions increase with a raise. Through the mid-30s and 40s, the investor rides out volatility and rebalances annually, maintaining discipline despite market noise. In the late 40s and early 50s, contributions approach annual limits, and consistent fee control preserves returns. By the early 60s, decades of compounding culminate in a sizable portfolio, and qualified Roth withdrawals may be tax-free per the rules. The point is clear. Steady, automated investing over time is the engine of wealth. Next, let's give you a quick reference cheat sheet you can screenshot. Use this concise checklist as a quick reference guide. It restates your account order, a sample allocation, rebalancing guidelines, a fee target, and key behavioral rules like automation and ignoring short-term noise. The markdown callout summarizes core fund tickers and the Roth tax benefit. With this cheat sheet in hand, let's do one more short quiz to reinforce the importance of fees and behavior. Our second quiz asks, over a 30-year horizon, which factor is most likely to make the biggest difference to your ending balance? The options are consistently choosing lower expense ratios, perfectly timing market tops and bottoms, chasing the hottest mutual fund each year, or holding dozens of overlapping funds. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The best answer is consistently choosing lower expense ratios. Over long periods, small fee differences compound, often producing large differences in ending balances. Perfect timing is unreliable, and chasing hot funds tends to underperform due to reversion and costs. Now, let's wrap up the most important takeaways. These are the key points. Start early to harness compounding. Choose a trusted custodian with low fees. Prioritize tax-advantaged accounts, often starting with a Roth IRA. Select broad, low-cost index funds, such as a U.S. and international pair, or a single global fund. Automate contributions, rebalance annually, and keep expense ratios as low as possible. Above all, remember that time in the market is more important than timing the market. Before we close, here's a quick visual to cement the flow from paycheck to portfolio. This sequence diagram shows the operational flow. Your paycheck lands in your bank account. On payday, an automatic transfer moves funds to your custodian. The custodian invests them into your target fund or funds according to your allocation. Shares are purchased, a confirmation is issued, and dividends are automatically reinvested. This closed loop is what makes set and forget investing work with minimal maintenance. With the process visualized, let's summarize and close out. In summary, select a trusted platform, open a Roth IRA if eligible, and buy broad, low-cost index funds. Automate contributions, reinvest dividends, and rebalance annually. Maintain fee discipline, because fees quietly erode returns. Most importantly, stay invested for decades, letting time and compounding do the heavy lifting. Finally, here's a brief reminder that this is educational content, and you should consult a professional for personalized advice. Thanks for watching. If this was helpful, please like the video, share it with a friend, and subscribe for more simple wealth playbooks. Tell us your allocation and automation tips in the comments, and let us know which topics you want next. See you in the next episode.